Hello everyone, welcome back to Rise Finance. In today's video, we will look at how to construct an efficient dividend starter portfolio. Let's check it out. While picking stocks for your portfolio, you need to understand few key principles. I always like what Peter Lynch, the famous fund manager, always used to say, invest in what you know. Yes, that's true. Know what you own and know why you own it. They sound very simple to read, but are very fundamental. One needs to know what they're investing into. If not, it's like playing poker without even looking at your cards. So, without any further delay, let's check our starter portfolio stock by stock. To recap from our previous video, where we discussed all the criteria that one needs to consider the dividend stocks for their portfolio, let's see these factors just for one more time. One needs to know the payment history, that's how long has the company been paying dividends, what is the dividend yield of that company, and what is the average rate at which the dividend is growing, how much is the company paying out as part of its dividends, and then what is the price to earnings ratio. Now, the way I have constructed this portfolio is assuming that the investor has $1,000 to start off with, and this $1,000 is spread evenly across all the stocks we'll be discussing now. The first company we have here is Verizon. This is from the communication sector. Many of us are actually customers of Verizon. We use their services to be in touch with everyone around us. When we go into the details of the company, we see it has a P ratio of 9.81, which is very good, with a yield of 4.79%. And when we go into the dividends, we see they have been paying for the last 17 years. That makes it a dividend contender. The average growth rate over the past 5 years has been a modest 2.1%, which is in line with the general inflation. And the payout ratio is below 50%, which is good. The next one we have in the portfolio is Comcast from communications sector. Comcast is also one of the very well-known businesses around. It is a well-spread media house, I would say. It has its TV business, it has theme park, and also mobile communications. So a well-diversified portfolio. Comcast has a yield of 2.25% with a PE of 13.14, which is again a good number. And when you look at the dividends, it has been paying for the last 5 years, which makes it a dividend challenge. The average 5-year growth rate is very good, 12.7%, which is well above the inflation that we have right now, around 7%. The next one in our portfolio is Home Depot. Home Depot is a very well-known home improvement retailer. It has a yield of 1.89% with a PE of 22.4. And when we look at the dividends, it has been paying for the last 12 years consecutively. And it has a very good 5-year growth rate of 19%, which is amazing. The payout ratio is also less than 50%, which is good. Next in our portfolio is McDonald's. Who would not know about the golden arches? It has been there for so long. McDonald's has a yield of 2.18% with a PE of 24.7. And here we see it has been paying dividend growth for 45 years. It is a dividend aristocrat and it has a good 5-year growth rate of 7.78, which is more than inflation. Payout ratio is slightly higher at 56.5, but that has not stopped the company from paying good dividends consecutively. Next in our portfolio is Target, which is one of the famous big box department stores in the country. Target has a yield of 1.76% with a PE of 15.43, which is very good. And from the dividend point of it, it has been paying for over 50 years. That makes it a dividend king actually. And the growth rate also has been good above inflation at 7.45%. The payout ratio is amazing, just over 22%. The next stock on our list is Pepsi, which is a multinational food, snack, and beverage company. Now, everyone would have heard about Pepsi. If we look at the brands that Pepsi owns, we see alongside the drinks, we have the Lay's chips, the Doritos, the Quaker Oats, the orange juice from Tropicana, Cheetos, Tostitos, Mountain Dew. The lineup is quite amazing. When we look at more details, Pepsi has a yield of 2.59% with a PE just below 25. And from a dividends point of it has been paying for 49 years. So just 1 year shy of being a dividend king. Again, the 5-year growth rate has been above inflation, which is good. Payout ratio, I would say, is on a high side, but that has not stopped the company from paying its dividends for like almost 50 years now. So that's a good sign. The next one on our list is Procter and Gamble, which is a very well-known consumer goods business. If you look at the brands that Procter and Gamble owns, they are very diversified across the board, from baby care, Pampers, to fabric care brands like Bounce, Gain, Tide, Bounty, feminine care products, grooming products, hair care, home, oral care like Crest and Oral-B, and also the personal health care products like Vicks. That is why such companies are actually called as consumer staples, because their products are something that we use in our day-to-day life. Looking at the details for Procter and Gamble, we see it has a yield of 2.2% with a P slightly high at 27. When you go into the dividend side, it has been paying for over 65 years now. It is a dividend king with a modest 5-year growth rate of just over 5% and a payout ratio of 60. The next one in our list is Walmart, which is again a well-known department store in the country. Walmart has a yield of 1.61% with a P of 20.68. Look at the dividends. It is just shy of being a dividend king, just like Pepsi earlier at 48 years. The 5-year growth rate is pretty modest at 2% and the payout ratio of 34%. The next one in our list is JP Morgan from the financials. JP Morgan is a well-known company that provides banking and investments. JP Morgan has a yield of 2.58% and a very good PE of 13.6. When you look at the dividends, it has been a payer for the last 9 years, so that makes it a dividend challenger. The 5-year growth rate is good, over 15%, and the payout ratio is also good, just below 25%. Next on our list is Prudential from the financial area again, which provides insurance and other financial services. Prudential has a good yield of just over 4% with a very good P just below 10. On the dividend side, it has been a payer for the last 8 years, which again makes it a dividend challenger. The 5-year growth rate is good, just over 10%. Payout ratio is also good, below 31%. Next in our portfolio is Johnson and Johnson, which is another famous company from the healthcare sector and known for its consumer health products and medical devices, and of course the pharma area. When you look at the consumer health products of Johnson and Johnson, we see products like Tylenol, Benadryl, skin products like Aveeno, and also essential health products like Band-Aid and Listerine and Johnson's Baby. So it's again a company which has a well diversified line of products which we always use in our day-to-day life, like consumer staples, but also into niche areas like surgery and orthopedics, wherein it creates some surgical equipment. When you look at the details, it has a yield of 2.54% with a very good P ratio just below 16. From a dividends point of view, it has a dividend king paying for almost 60 years now at a modest growth rate of just below 6% and a payout ratio of 42.76. The next one in our list is United Health Group has a yield of 1.21% and a P just below 22. When you look at the dividends, it has been growing for the last 12 years, so that makes it a dividend contender. The 5-year growth rate has been amazing at almost 19% with a payout ratio below 30. Next in our list is 3M Company, which is an industrial company that manufactures products that are used in healthcare, worker safety, and other areas in the industrials. It has pretty much a long list of products which most of us use, like the command strips, the scotch tape, the Scotch Brite. 3M has a yield of 3.83% and a PE below 15. From dividends point of view, it is a dividend king which has been paying for the last 63 years at a modest 5-year growth rate of 5.65% and a payout ratio just below 60. Next in our portfolio, we see waste management, which as the company is aptly named after, it helps in controlling and managing the waste services that come from homes and factories. Waste management has a yield of 1.61% and a P which is little high in my opinion at around 26 and a half. From the dividends point of view, it has been paying for the last 18 years. That makes it a dividend contender. And the 5-year growth rate is good at 7%, meeting the inflation, and a payout ratio below 50. Next in our portfolio, we move on to the real estate sector where we see a company that is Realty Income. Now, many of you may not know what Realty Income is. It is a real estate investment trust that invests in commercial properties and leases them out to companies like Walgreens, Dollar Tree, and other such retail. The best part about realty income is that it is a very, very famous REIT that many people invest in because not only does it pay its dividends monthly, but it keeps increasing it regularly. When we see here, the yield of realty income is 4.39%. From a dividends point of view, it has been paying for the last 25 years, so that is a dividend aristocrat. The 5-year growth rate is pretty modest at 3.37, and our payout ratio of real estate investment trust is always high, so we can't say this is really a high number. And like I just mentioned, it is a monthly payer. Next in our portfolio is American Tower Corporation, which is again another real estate investment trust that owns and operates wireless and communications infrastructure. Wherever we see companies like T-Mobile, Verizon, AT&T, and T, and others setting up their infrastructure on the towers that we see, those all towers are maintained by American Tower Corporation. This has a yield of 2.39%, and it has been paying for the last 9 years, making it a dividend challenger. The 5-year growth rate is amazing, over 19%, and again, payout ratio is always high because it is a REIT.